Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to be going through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what people are sharing. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com. I dive deeper into all these topics, sectors, looking for potential investment opportunities, sharing what I know with everyone in the community, doing a lot of sessions on a variety of investment themes. We're going over portfolio position sizing for the next one. And we've covered a whole bunch of different things in the past of things that I follow and track in the markets on a macro perspective. We'll be talking about one of those things in this clip that I track, which deals with the real estate cycle. If you're interested in joining and learning more about investing, if you listen to YouTube clips nonstop, if you're always looking at the stock market, looking at potential investments and companies, you're going to fit right in. I mean, that's basically what I do, and I think a lot of people do that. That are part of the community. We also have a Discord that we go back and forth and share a lot of companies and charts and all sorts of stuff with people that are a part of it. So coming down, we've got uh, something that I posted here. Total construction employees find the recessions. So this is all employees construction. You can see it wiggles down for some of these times here. We've been heading higher here recently. We're at 8.31 million and it's continuing to increase. The latest data that this has provided was October of 2024. You generally have a month looking backwards. They release this information mainly in the middle of the month sometime. So right now, all employees construction has been going up. If you look at the times where they decline, it declined in 2020 recession. It declined here in 2008 recession, 7, 8. It declined here in 2000, 2001 recession. It declined here in 1990, 91 recession, recession, recession. Wait, every time all employees construction declines, we get a recession. A lot of people and what they teach in master's degrees at schools is to look at the unemployment rate. The unemployment rate going up basically comes from all employees construction. So this is the leading indicators. Now you can back that up and you can look at housing starts. Housing starts is linked to all employees in construction. I mean that's what's going on here. And I know some of it's cut off on the right hand side. It's almost all on here, but the dark lines are recessions. And if you notice, before those recessions, we have declining in housing starts almost every single time. And the decline also has all employees construction that is declining in almost all of these scenarios. And this wasn't a very large decline. It declined, which kind of sparked that bubble in technology. And then we went up when they lowered interest rates and apparently wanted to lend money to anyone and everyone, which created a gigantic bubble in the housing market. A lot of people talk about 2007 and 8 and that bubble that transpired in 2008 as this recurring over and over and over and over. Like we're going to have a 2008 crisis in 2025, or it's going to be the biggest one like 1929 crash. Guys, it's not. And I'm fairly confident it's not. It doesn't mean with 100% certainty, but I'm fairly confident because the 1920s had a real estate crash in the 1920s, so which led to the 30s blowout deflationary problem. 2007 and 8 had the same exact setup as the 1920s. It was the same setup. It's the same thing. They gave a whole bunch of loans out to people who didn't put much money down, and then they went bust. And then that bust was a deleveraging of bad debt in the system coming off the books, which is deflationary, of the banks. Do we have that same scenario right now? No, not even close. And the fact that the majority of people do not understand that makes me, you know, question exactly what they know, because they're not really looking at history, I don't think, that well. But that's what we've got for current data, and that's what I'm seeing. And some people say, or have said the last, clip, why am I so sturdy, or why do I stick my ground so well? It's because the data hasn't changed yet. This data continues to go up, and this is what I'm tracking. And it's housing starts in this. And I don't change my mind because the data hasn't changed. And some people say, it's going to change. Well, you don't have to predict it. Just wait for it to flatten out and turn, and then change your mind and be like, hey, look, I think a recession is going to come. And that's when it peaks out and starts going down in each one of these cases. And right now, it just hasn't rolled over and gone down. And another leading indicator that a lot of us, well, not a lot of us, but me, that I use, is using technical analysis on the home builders. Because home builders, the people who invest in home builders look 18 months kind of out into the future. And all of those are going up. It makes me think that we are going to build more homes, that this construction number is completely legit. The reason this is so important is because it's going to impact money flows. And when we go into this stage of demographics, when we go into this stage of construction, and how the demographic interacts with the housing market or real estate market, certain investments come into favor, and they're generally commodities and commodity related. The dollar too, we have to watch that and see if it declines. If we get a combination of both of those things where the dollar starts to decline and we go into a construction boom, I think we're going to see commodities go into a very good tailwind environment. And that's why I'm so sturdy on it. The Great Marti, it says the future of banking, not your keys, not your coins, and Coinbase. Your account is currently restricted. Coinbase will review your account internally and will send an email once our review is complete for further information. You don't want to touch this crap, guys. And yeah, I'm talking about crypto and all that stuff. I don't trust the on ramps and the off ramps, which is like the Coinbases and all that. I think a lot of crap's going down. That's all. Jacob, here's another one too. Breaking: Tether has minted another 1 billion in USDT out of thin air, setting a new record with 16 billion issued this month. What's going on here? Really, what is going on here? Here's one: the 3 inflationary waves. This is what people, or someone had put COVID supply shock as the first wave. And that's 20 down to late 2024, early 2025. We move up, which is services, energy, food, moving on up into scarcity, which is deglobalization, de-risking. On the back end, it says shelter here, and a debt crisis currency out in the late 2030s. I think that's about right. And I think that's pretty much spot on to what I think is going to occur. So, and here's another thing: COVID didn't have a supply shock. There was no supply shock during that time frame. They just printed a whole bunch of currency, which put everything into a shortage. So it's not a supply shock. The supply is the amount that can supply for the currency that's in existence. Currency is demand. So for the most part, humans' demand is innate. Take a little kid. Just do this as an example. Find someone who's like 5, 6, 7, 8, 9, 10, 11 years old. Go ask them, if you had unlimited amounts of money, what would you do? They would probably go buy a bunch of crap. That's the majority of people. If they had a whole bunch of money, they would buy a bunch of crap. So if you give a whole bunch of people a bunch of money, then they're going to go buy a whole bunch of crap. And what happens is if you increase the money supply and then by 40% or so, and then you give people a whole bunch of money, what do you think they do with it? They go buy a bunch of crap. And then when they go buy a bunch of crap, guess what happens to the crap? It doesn't exist anymore. So the prices go up. It's that simple. But the three inflationary waves looks to be about right. Um, the question that I would ask if it were me, I would say under these conditions, what investments go up the most? I've done some pretty good analysis on ratios to see what ratios of commodities, in particular specific commodities, perform the best under these conditions. And there's like three or four that come out on top. And some of them are just ridiculous under these conditions. And you don't have to take on all the risk in the world to get very good returns. So I incorporate all of that understanding when I looked back in history to figure out what I think is the best opportunities in the future. And I think they're going to mirror previous commodity bull markets. So I am investing in certain areas um, with a strategy to capture as much as I can out of this bull market. But yeah, a lot of people say, well, why did you ride this back down, or why don't you sell out and do all this and try to time it all? Well, in the beginning, you usually get the most market movement. You get a big first wave, and the second wave is the largest pullback. It's going to A lot of people are going to question you. That's the disbelief phase. That is the bear trap. That's what markets do. Depending on the company, some companies don't pull back that much. They might be buying back shares, um, doing something on the lines of share buybacks that kind of mute how far it falls. Some of them, they've bought so many shares back that the stock continues to go up. So it never had this pullback. It just kept going up and up and up and up and up and up. It's crazy how much some of these have gone up, even with the price of oil going from low 100s down to where it is today at just under $70 a barrel. And the stock really hasn't gone down for some of them. But this is what's coming, guys. This is my opinion, and this is kind of the bigger picture view and the vision that I see out in the future. During this time frame, the companies that consume commodities are going to struggle. Your S&P 500s, your Nasdaq. There's going to be more people spending more money on these things here: services, energy, and food, and it's going to draw currency away from what people want to spend on. It's going to have to go to what people need to spend on. So there's going to be a shift from a consumer perspective and also from an investment perspective as we go through these waves. The Great Marquis, Nasdaq. So when I talk about this wave and the things moving, we're looking for evidence for potentially the S&P and Nasdaq to go sideways or lower. So he says, Nasdaq update: measured move criteria has been met. Target hit to perfection. She's beautiful. So here's your first leg and the target of this big, we'll call it a flag pattern. You put it on the bottom here to the flag, and then you run it all the way back up, and that's where you get your move. So he's maybe predicting that we could get a potential turn soon, but we'll see. Again, a lot of people trying to call tops. It's very difficult to do, and a lot of people don't get it right. But I just look at it like it should be topping soon. That's all I'll say in my view of it. It means that I shouldn't be in this area. That's what it really means. It doesn't mean that I should short it. It doesn't mean that I should take some position on it and try to time it. I go when I look at what's undervalued. I go and I look at what has historically outperformed with these certain sectors that are undervalued, and then I take positions in the undervalued areas. It's all asymmetric, and then I just let it play out. I don't worry about it day in and day out. But some people, they want to try to capture these moves, and the tough part is when you're at the end of a bull market, that's where you get the largest moves. So it's going to draw the most amount of retail people in. And that's where crypto and NASDAQ and AI, it's going to draw everybody into it. and they don't even know that it's drawing them in. They just think, oh, look at the returns, look at the price. And that goes back to the saying, everybody knows the price of something, but nobody knows the value. They are literally just FOMOing into things. And that's where risk is at because they don't know the value of anything. They just know the price. Oh, the price is going up. I should go buy it. Like, okay, good luck with that. Giovanni says US air travel, TSA total traveler throughput in million passengers, 7-day average. So 7-day average, about 10% above 2019 level. And there we are here. You can see it was a little higher in, oh, this is all 24. So 24 is higher all across the board here in the red. In the 2019 is in the black there. We're above that all throughout the year. EU natural gas inventories and percent of full. So EU's at about 87% rounded. Germany's at 92%, Italy's at 91%, France is at 81, Netherlands is at 75, Austria's at 89%, Spain's at 94%. But you can see how these are really in 2024 pulling on back. That's due to colder weather, and it's also due to natural gas turning on because they don't have a lot of wind. So we'll see where this ends up in terms of inventory levels. We could see a huge spike in natural gas prices if it remains cold and windless. 50 baggers. So John Quakes was talking about NXE, which is NexGen, was my first 50 bagger when it hit its all-time high in Canadian 1251 high on the TSX. It took over 11 years of patience to get to a 50 times return, but it's not done yet by any stretch of the imagination. Cheers, mate. So that's him showing some buy orders back in 2013, 11 years ago. That is the exact thing that I am interested in investing in. Now, NexGen, I'm sure, was pretty risky in 2013. I don't know if they had found their NexGen, what was it? Their deposit, their big deposit, Arrow deposit. But 50x on 11 years, congratulations to John and anyone who has the fortitude to hold that long and get that type of return. It's not easy. You're going to get a lot of pullbacks during that time frame. And I know a lot of people would say, well, why didn't you sell out after you got, 2 times your money or whatever? Trading in and out, I hate to say it, guys, it's almost, I think it's impossible to outperform taking a buy and hold strategy so long that your buy and hold strategy is in good, solid companies and you get a few of these in the portfolio. I was lucky enough to buy the bottom of 2020 in oil. And I'm hopefully going to be lucky enough to buy the bottom here in gold and silver stocks, where I buy some of these things and I just sit and I hold on to them for a good chunk of time. I don't let the volatility bother me. And well, at least I don't let it try to bother me. Sometimes it does get to me a little bit, depending on how big your positions are and how big the pullbacks get. I get a little bit queasy at some times because when you get your baggers up there, um, and depending on the sector that you're in and how much money you have in it, and if it's correlated. So I'll just talk real quick about it. In 2020, specifically September, October, November of 2020, I went into a good chunk of oil and natural gas companies. Some of them, a good chunk of them, turned out very well. They are all, so I probably went into maybe 20 different companies at that time, maybe 25 at most. A good 10 of them are up over 10 times my money. Some are up over 20, 30 times on 10 of them. On about 50 or 60% of them, I'm up over 10 times my money on that amount. The problem is they're all correlated and they all go up and down together. So if you get a big pullback and you've got that amount of money, you get a huge 50% drawdown or something like that. And it is a huge, it's a gut punch. But I'm holding on. I'm going to continue to hold on. And much like John Quakes, I'm doing the same thing. I hope by the end of this bull market that a few of them will be over 100 times in return. The good thing about holding longer, there's a couple of things that people don't think about. A lot of people think about the returns. I mean, and that's fine. And some people say, well, you can get a bigger return if you try to time things. I don't think that's possible. I don't think the market in the short term is very easy to get right. I think if you get a really good entry point, you can hold it for a long time. You get lower taxes. You go from short-term capital gains tax to a long-term capital gains tax, unless you're in a retirement account. And depending on what you're in, you might start to accumulate dividends too. I've been getting a lot of dividends. And the weird part is the amount of money that I put in some of my companies. I'll just give an example. So if I put $10,000 in a company and it went up, let's say 20, 30 times, that is now, 10,000 turns into 200 or $300,000. I'm getting a dividend on that now, and the dividend is a couple percent. So if you're at 300,000 and you're getting a 2% dividend, that's $6,000 a year. I only put 10 grand into it in the beginning, and I'm getting a $6,000 a year dividend yield or more, depending on the payout that I get. And I've got a couple of those companies doing that. I've described to people that when you take some of these positions early, and it does require a lot of patience, guys. It's not overnight. That at some point it is very possible that you will be getting yearly dividends larger than the money that you put into the stock in an original investment. And I am taking on positions right now in companies that could potentially do that. Now, I don't know for sure, but that's what I'm hopeful for. And if I can spread it out and get, a good 4, 5, 6, 7 picks across different sectors, and they're companies that are way down because of the commodity, I do think that that is highly possible, given history of the dividend payments that they did historically, and where I think maybe 4, 5, 6, 7, 8, 9, 10 years from now, the prices of the commodities could be at. So again, if you're interested in that type of stuff, I'm sharing all of that stuff on the website. That's exactly what we're looking for, is this type of stuff. NexGen's a little bit different. That's got a little bit more risk than what I would probably typically like or be completely comfortable in. I do take risk. I just wouldn't put a huge amount in it. That's all. Giovanni says drilling activity in the U.S. Baker Hughes primary vision is still pulling on back here for oil rigs and frac spread. But I do think it'll eventually bottom out at some point here, I think the next year or two, and start to turn back up. And that's going to deal with just flat out oil production. And I think supply is probably going to drop a little bit, or be stagnant, I should say, while demand goes up. Money wisdom: as debt increases, you narrow the range of outcomes you can endure in life. So as your debt increases, you become more susceptible to market swings, is what he's saying. And that's what happens with a lot of people who use leverage. They borrow money, they use margin debt, they buy stock or whatever with it, and then your market swings will kick you out at a bottom. That's exactly the worst time to sell, is at a bottom, when you get a margin call or something like that. So you want to be resilient enough where you never get a margin call, is what I'll say. U.S. liquids production in September was 13.2 million barrels per day, down from 13.4 in August. So some people, they're talking about a potential peak in shale, and I don't believe it yet. The reason I'm going to be hesitant is that we've got really low oil prices, and natural gas prices. So when those are low, we don't know what we can produce. So I'm just going to be patient and see what happens. And if oil prices were to go to, say, 90 or $100 a barrel, then I want to see if the production goes up and how sustainable it is. Here's another one talking about that. Eric Nuttall says U.S. oil shale production year to date is down Lower 48, December 23 was 13.3 million barrels per day, and September 24 was 13.2 million barrels per day. There's no surging production. There is no market share battle with OPEC plus. Much of what you've been reading year to date is 100% wrong and is perverting the market's perception of reality. Peak productive capacity, 11.9 million barrels per day there of the lower 48 is what he's got. So let's just wait until prices go up, and then we'll see what shale oil and what the world can produce. I'm in the camp that within the next 5 years, and I don't know exactly when, we are going to find out what the world can really produce. And when we're at pumping capacity of the world, this is going to get real hairy. And when I look at investments under that scenario, the way that they would have to handle that is they have to put everybody into a recession to dampen the blow if oil cannot be produced at greater quantities. I also think bond markets are going to come under pressure. And the best investments in the world at that time are going to be energy investments, and also I think precious metals, because you don't want counterparty risk, and you want to be able to view that before the reality comes. It's better to be a couple years or even 5 years too early than be a month too late. So the window of opportunity is before that, and people are going to figure that out if shale cannot increase and OPEC can't increase. If that's the case, then where's the oil going to come from? And under that scenario, I think people are going to panic. Uh, you know, countries and companies and all sorts of stuff, and we could start to see things be different. People, they might start buying physical assets. Like they'll just buy a mine, they'll buy this, they'll do that, they'll secure energy. They might do things a little bit different than what they did in the past. They might start investing large sums of money with certain companies, kind of like GM partnering with certain lithium companies. Stuff like that's going to start to occur. Warren Buffett says cash is to a business as oxygen is to an individual. Never thought about it when it is present, and it's the only thing in mind when it is absent, says Warren Buffett. And a lot of people, they invest a lot of money in companies that are not cash flow machines. And that's where I get a little bit weary and a little bit uncomfortable. It's like, man, you guys are really taking on a lot of risk. And that's where they do dilution and all sorts of stuff like that. But that's what I've got for today, guys. We'll end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Black Friday coupon code is still active. And we'll catch you guys later. This is Finding Value.